Peter, can you hear us?
I can.
Hey, Peter.
Hey, Peter, how are you? Welcome to our house.
Yeah, thank you very much for having me again.
Welcome, Peter. It's Steve. By the way, sorry, Dale, go to webinar crashed, so I'll let you do the interview. I don't know up to what point you heard.
Have a great interview, gentlemen.
Yes.
Thank you very much, Blake. Don't worry about it, Steve. Very good presentation. So, Peter, welcome to the F.A.C.E community. So, I don't know if you want to show your face or show your charts, but you can share your screen.
How about now?
So everyone, I want to tell you a little bit about Peter. I met Peter on Twitter, and we started tweeting, and I invited him for an interview, and then we had kind of a inside joke together. And I talked about that when I was interviewing him, that I thought there was going to be one more slide in the S&P, right, Peter?
Right.
And you didn't, and there was, and the bet was, if it happened, he'd have to buy my old Ford Pinto. Okay? And you did. You had to buy it. You bought it. You said you picked it up.
No,
it's
hold
an
on.
imaginary car.
A second.
Huh?
Let me correct myself. We had a double bottom back in February. The summer 2015 low was retested. We had a double bottom, and I said from there on, back up the truck, right?
Right. Well, right. Well, how did you end up with my Pinto then?
Well, I had it refurbished. It was remodeled.
Oh, okay.
You're gonna love the picture. You're gonna love the new look of it.
I can't wait to see it. Maybe you'll drive to California. Where are you located again, Peter?
Florida.
Florida. Okay.
Long drive.
But I do recall the tweet and not the day that you said, Dale, I'm now backing up the truck.
Right.
And I'm backing up the truck and I'm filling it up. I'm buying as much as I can.
Right.
When was that, pre-election?
That was, I called the low, when the double bottom happened back in February. That was it. You could have bought in the summer at the low of August 2015. You would have been perfectly fine.
Yeah, but you sent me a tweet. I remember the tweet you sent me was right before we entered a blow-off stage to the upside, where things really just became vertical.
Yeah, everything was pointing to a blow-off from there. I mean,
so what's interesting to me is I got a recent tweet from you that you think that in the next couple of weeks, this advance could run into some difficulty. Am I reading that correctly?
The high in some indices is not in yet. Some indices. I think the S&P and the NASDAQ still have more to go. But we're in the final stages of this advance that began from the largest degree of trend. I say it started at the low of the flash crash of 2010. That's one large wave. Now the advance, and it's in its final stages. The fifth wave of that advance began at the low of February 2016.
So this is 5 of 5 of 5 of 5 and completing something?
Actually, the coming high will be wave 3, or I'm sorry, wave 3 of the largest degree. In other words, the third wave of the trend that began on March 2009 is about to end.
I see.
Wave 3 that started 10 years ago.
So we could have fib retracements. Even a 23% retracement of that move would be a pretty big hit to the market.
We're going to have a 50% retracement of the rally that began at the low of 2010. In other words, we're going to revisit the 2016 low. Everything that happened from 2016 up till now will be revisited. You have screen sharing on?
Yeah, there is a screen sharing. I'd love to see your charts.
What do we have on the screen right now?
You're the presenter, so right now I just have you and me on webcam, and you're showing your desktop. So if you could
my regular desktop. Okay, let me switch over to the second monitor right here. Do you see any
There,
chart?
now we see it.
Okay.
Okay, we see
So-
the trannies.
Let me talk. Yeah, so the trannies, in my opinion, have topped for now. And, you know, when we talked about this post-election move, which began, of course, somewhere in the summer, October, I would say, July, summer 2016, we started seeing evidence of a breakout. And it was all based on the pattern that I captured right here.
Mhm.
And I thought that the first hurdle would be here, the 1.618 extension of the XA leg, which is 98.53. We came awful close. We have from a Tom DeMark perspective, we have a 913.9 that will be registered at the end of this month. There's a 913 here. It led to a brief pullback, 3 months pullback here.
Are those numbers, Peter, Tom DeMark stuff, the
Yeah,
9
they
to
are.
13?
Those are DeMark stuff. So that
Okay.
13 led to a pullback. It was a partial retracement of the rally that precipitated or that came on the heels of the February low, and then we took off. And eventually we're going to get up here at the 11,000 on the trannies, but not now. So I think the trannies, if I'm not mistaken, may have topped for the year. On the smaller degree of trend, I can see a terminal diagonal there. So there's a possibility the trannies have already topped. I believe the bank index, the NASDAQ banking index, it hit a very crucial area for me right here, the top of the Andrews pitchfork, and this alternate bad area. It reached the top of that area before it turned back down. This is institutional selling on the financials, if you ask me. But as you know, institutions, they unload in phases. They cannot crash the market by unloading everything they got. They do it in phases. Every new rally is an opportunity to sell. Eventually, the banking index will reach much higher, but not now, not now. I think this might have topped for now. The S&P, here's the double, well, that was the February low, and if you look at it, it's an ABC decline. So the summer low was right here. We came back down and tested the
Right.
October 2014 low, completed an ABC. And that was good enough for me to call for the fifth wave in blue. So that's the lower degree of trend. That's what we were talking about a second ago. So if my analysis is correct, blue wave 5, which began, which is associated with this 5-wave run that began at the low of the flash crash 2010, 1, 2, that's 2011,
Right.
3, 4, 5 is supposed to end here. I don't think it has ended yet. I think it still has a little more to go. Once it reaches this area, we're going to see
2,500?
Yeah, we're going to threaten 2,500, and then we're coming all the way back down here. From the bottom of yellow wave 2 or orange wave 2, which is where wave 1, blue wave 1 began. That's the flash crash low. This whole thing is a 5-wave move. Once it ends, a 50% retracement will take us back to the low of October 2014, which is also the low of 2016. So we're going to have that, and then that will give, not will because there's no guarantee, but I believe that this should be the start of orange wave 5 taking us towards 2,900.
Wow, interesting.
Okay.
You know, I have a question for you, Peter. I see you use everything. You
Right,
use
I use a
Onyx,
lot of things.
you use DeMark, you are an Elliottician.
Mm-hmm.
Which of these, in your view, having been a practitioner of all of these,
Mm-hmm.
is the most reliable, either standing alone or in combination with?
I don't believe there's any one thing that is reliable. One mentor told me a long time ago that technical analysis is like prosecuting a court case. The more evidence you have,
I've used that metaphor. Yeah.
you know, So you
So
have to have
confluence. So
corroborating evidence.
confluence is a big deal for
Confluence of
you.
evidence. That's right.
Okay.
So that's where I think the best opportunity for buyers is down here. And right now, there is definitely evidence of systematic unloading of risk. It's happening slowly in a stealthy fashion, and it will take
Where do you
weeks and
see it?
months.
How do you know that? Where do you see it?
Well, I see it in utilities, for
Okay.
example.
And the bond market, so you're saying
The
people
bond
going,
market has begun to turn up.
right, so it's
You know,
people beginning to seek safety and the gold on the verge of a breakout, that
that's
too?
right.
Okay.
You know, I do like the configuration of the gold chart right now, that there's an opportunity in gold right here, especially
Okay.
if it breaks above the previous high. But the bond market, I was looking at TLT earlier, the 10-year, and
Yeah.
I do like it where it is right now, even though
I was
play it.
thinking at the minimum, why not fill the gap at 130 on TLT?
Yeah, why not? That's right.
You know, if not, there were only two drives, you could even get another high out of it.
It's very possible.
And don't you think that would happen once 5 completes and it's on its way to 4? That those moves accelerate?
Yes,
Okay.
and that's what happens during the formation of a top. You see money flowing out of the risky assets slowly in a very stealthy manner and slowly, going into these safe dividend-paying stocks too. For example, I was talking earlier about the XLU. You'll see the XLU has formed a double bottom right here. Not the XLU, but relative to the S&P. I look at the XLU relative to the S&P. So that's a relative strength ratio chart.
So it's starting to show higher lows, higher low.
Well, here's the XLU from 2009. I see here a cup and handle. You had that post-election reaction. But these two here, this is called an ascending base. This is a very bullish configuration for the XLU.
You think we could get a 50, 60 VIX reading when that wave 4 begins? I mean, we're so compressed in volatility, Peter. Isn't that, like markets top in violence and bottom in silence, and people aren't even buying protection anymore. They're going, you know what? It's a waste of money.
Right.
Why should I buy options that expire all the time?
Here's the thing. The smart money protects in various different ways. They collar their positions using options.
Yeah.
They rotate into other assets. They diversify. They don't always buy VIX to protect. And VIX, that's a sucker's game, in my opinion. It's just
or S&P puts.
Or puts, But I always recommend for those who have stock positions that they don't want to let go of them. They want to hold through thick and thin. Why don't you use the options collar strategy?
Oh, so you strangle it? You just strangle, you sell puts above and sell calls underneath?
No, well, with the collar strategy, what you do is you sell covered calls, and then you use the proceeds from the call selling to buy puts. So that protects you against the downside, but you finance that through the selling of calls. I have a video on that, by the way, that I've recorded. It's a very extensive video on the collar.
Do you do anything in currencies, Peter? That's our big league in here.
I know nothing about currencies. I don't.
All right. Do you follow the dollar? Does that come into the mix at all?
Every once in a while, but it doesn't come into my analysis. In my model, the currencies don't play a role because, here's the thing. At some point or another, it's 6 of one, half a dozen of the other. If you look at enough things, you will get the signal that you need. If you look at too many things, you'll start suffering from analysis paralysis. And that's not something, you know what I'm saying? So a couple of indications, by the way, that the rally was about to expand, around the elections. Here's the SOX versus the S&P. It has been such a reliable indicator for me because back in 2011, February 2011, this ratio, the SOX versus the S&P, reached the 2007 high that preceded the crash, 2007, 2008 crash. And then we formed a bottom. We had a bottoming formation right here. We rallied back to it, 2015. That signals the start of the correction.
Right.
And then here, when we finally break through this 2007 high, this double top, that was an indication for me that the market is about to take off like never before. Yeah. And look where this ratio is. I still think that the semis are the biggest opportunity in the stock market for years to come. Gaining,
do you think there could be? Do you think that if after we get to 2,500, when you know all the caveats, and we get retest back to last year's lows, that the semis might retest the breakout?
Yeah, I think it would retest the breakout. It's going to come awful close to it. It's going to be at least a 20% correction, maybe more. And because, you know, when I tell people that, they don't believe it. But listen, I mean, so far, everything that I've used in my model has served me well. So I have no reason to believe otherwise. Okay. So, but listen, that's not how I trade. That's not how I trade.
Anything on oil? Because oil's a pretty big component. You have a view on the oil shares or the oil?
Well, I was looking. Yeah, I mean, that sector is, I mean, when you look at, what is it, USO, United States Oil, the ETF, it's, I mean, that sector, the oil sector or the energy in general is depressed. And I'm not sure I understand why that's the case. But that's also a telltale right there. That, you know, here's the thing with oil, it is always subject to geopolitical things that are beyond my comprehension. So I do not include it in my analysis. I don't. I look at it, yes, but I really don't use it as a premise for what I'm going to do as on a week in, week out basis. Because from a trading standpoint, I'm mainly an options premium seller. That's what I do.
I have a neighbor who's from Israel, and he says every time oil gets too low, ExxonMobil starts a war.
Right. Yeah. You know what? Huh? Yeah. You know what? That might not be an exaggeration.
Yeah. So, you know, we had that $25, $30 oil. Let me ask you this. The Saudi Aramco deal, could that also be kind of a tell that why are the Saudis, after all these years of reaping billions and billions and billions, are going to let the public buy into their deal?
I don't know. You tell me. You probably.
I don't know. I'm always skeptical when someone goes public with something that, you know, why do they need anyone else's money if it's so great?
Right. Exactly. You know, eventually this oil, the whole oil business, even, you know, eventually we need to forego the reliance on all that stuff. And, you know, with, you know, we need new innovative sources of energy, and oil isn't one of them. So, you know, whenever you hear commercials about buying oil wells and things like that, you know that it's a done deal.
I wanted to ask you, Peter, when it comes to time, do you do anything with, like, you have these views and you have numbers, but Gann was pretty big on time. Do you have any ideas of, like, timing wise, that perhaps this is a second half story, that, you know, maybe the S&P's pull back to 22 and a half and then make that run?
I've always tried to incorporate time into my analysis, and even though Gann believes that time is even more important than price, I've learned to stay away from timing things. All I know is one thing I can tell you is that when the market is ready to crash, it does it on a Thursday or a Friday when options premium is at its lowest. Okay.
So the option writers are going to have a bad expiration coming up sometime this year.
Exactly.
They write them. They write them.
So in summer 2015, I called for the crash a week ahead of time. I said by next week we should be in crash mode, and that happened.
So give me your notes for Ghostine, that the market will top by then and will begin this retracement by then.
I think by sometime this summer, after this earnings season is over, we're gonna start seeing a top forming. We haven't seen it yet, not in the S&P, not in the NASDAQ. So until I start seeing a top, I can't.
Would you say the Russell, which has been demonstrating relative weakness to the rest of the market?
So the Russell is starting to lead. Now here's the Dow, and I'm going to show a similar chart of the Russell. Here's the Dow. That's a chart that I published back in 2013. It was still at 14,000. Everyone was making fun of it. And look how nice that happened, that Andrew's pitchfork right here, this channel. We rallied all the way up to the top of this channel, and then we came down summer 2015, retested the 2014 low. Notice that in February 2016, we didn't make a new low on the Dow. We retested. It was like a double bottom. Right. And then we rallied up to the measured move of this formation. So I'm very, very concerned about the state of the market right now. I'm not buying any indices yet, even though there might be an opportunity coming up very soon in the next few days. But it's going to be the last hurrah for this market before we come back down all the way to the 2014 and 2015, 2016 lows.
Yeah, wouldn't you think they'd want to take them out, Peter, just to scare everybody and trade like, 1790,
yeah, they might,
1700?
It is very possible, Dale, but it is very possible. It's not out of the question, but for me, fourth waves rarely ever exceed a 50% retracement.
Okay.
So, so that when I measured the retracement from my upside target, and I said, what would a 50% lead to downside, from a downside perspective? It was, it was right there at the 2015 lows. So if we reach that 2,500 and we get a 50% retracement relative to the rally that started at the low of the flash crash in 2010, we get a 50% retracement right there at the 2015, 2016 low. So it works out nicely. And, one might think, well, that's all coincidence. I've seen it way too many times. And it's almost like there's an invisible hand that engineers all that stuff to happen right when it's supposed to. Here's the Russell, by the way.
Yeah, the master mathematician who designed
You're right.
the universe.
You know what? You are absolutely right. There are hidden hands and forces that we don't understand, but if you really dig deep, you'll find them. And that's what I think here happened. You see that you did get a low in 2016 on the Russell. It was the C wave of an ABC here in purple. And I think right here we have a 913.9 on the DeMark count.
That's bearish.
Very bearish. 913.9. The fifth, there's some sort of fifth wave here.
Yeah.
This might have been 1, 2, 3, 4, and 5, which I don't show the higher degree. So I think at some point we're going to come all the way back down here somewhere. Okay.
What a great interview, Peter.
Yeah.
Really, thank you so much for edifying our community. I mean, a lot of people in here trade FX, but I guarantee you they all have retirement accounts.
Sure.
They're all in funds, and
this is the time to start protecting. This is the time to start implementing some protective strategy.
Okay, that's a great message. Look to be hedged in an effective way as we go through the year. I've seen Peter be very accurate. Thank you for edifying F.A.C.E. It was great to see yours.
I appreciate it. Thank you very much for the interview. It's always nice to talk to you, Dale, and I appreciate the exposure.
Okay, and stay away from Mar-a-Lago. It's going to be busy with the Chinese president there this weekend.
You're right. I should skip town. You know what? I might be flying up to New York. New York might be the safe place to be during that time.
And you can follow Peter on Twitter at Peter Ghostine. Peter,
Yeah,
any other place people can follow you?
Right. So Peter Ghostine, Peterghostine.
So thank you for your attention today. According to me, time is our most precious currency. Money comes and goes. Time is gone forever. Thanks for spending some of your precious currency with us. And thank you for your help, Steve.
Bye-bye, Dale. It was a pleasure. Bye-bye, my friend.
Thanks, Dale. Thanks, everyone.
Bye-bye, Blake.
All right, Blake. Thank you, buddy.
Bye-bye.
See everyone tomorrow.